Legal disclaimer. Bespoke Group investment advisory services are offered only through Bespoke Advisory, an SEC-registered investment advisor. Everything we share here is just for information and education. It's not investment, legal, or tax advice. Bespoke does not offer or solicit investment services to the general public. And as always, investing comes with risk, including the possible loss of principal. All right, Rob, are we going to get into it? I think we're going to get into it.
I'm ready when you are. This
All
is
right.
for your process of discovery.
Listen. I've gone deep. I've gone into the weeds. All right. Imagine that I'm like walking out of a lake and I'm just like covered in seaweed. Like we need to like, that's what I've been swimming in the seaweed. So now I'm like trying to zoom back out and think about how, like what is my entry point to the complexity of your work and what you do to bring this forward to like the lay human. But I do want to just start by introducing you, which is kind of a formality that I do think is important. And it's that, you are Rob. You've landed at Bespoke Group as Chief Investment Officer. And before this role, you managed $250 million in equity and bond portfolios for a Boston-based advisory firm. Did I get that right?
Yes, that is an accurate regurgitation of my LinkedIn profile.
Yes, but how could I forget to mention that you also have a bachelor's in classes in English? So,
which is
how did you
the
end
most
up here?
important. Well, I ended up here because I was going to be a classics professor. That was always the assumption, and then I had the shocking realization that that's a terrible idea, and kind of had to find a different path. So, this was a pretty good one if you like reading and learning and being curious about things, as you can tell. So that's turned out for the best.
Step from classics towards finance, wealth, money.
Yeah, I mean, if you do what we do, you have to spend a lot of time reading and learning and quiet and alone with yourself. And some people just kind of have a natural affinity for that. I certainly do. And whether it's, whatever the subject, what we do is a humanist pursuit in the sense that it's all about understanding humans and what they do and their structures and society and economies, and all of that stuff comes down to, the same root quest for learning and quest to just understand more and more, and knowing that you never will, but trying your best.
Yeah, what's that? I was actually thinking of this earlier, that what's that saying or that idea of like it's not like you never really, like the more you learn something, the more you realize that you don't know. Like you're never really like actually fully get there wherever there is or that is.
Yeah, it's like having a map filled with terra incognita, and you explore one part of it and it starts to reveal itself to you, but then like more terra incognita just emerges at the same time all around you as you go through that process, and you kind of have to learn to just enjoy that process and yet be able to act, because at the end of the day, like you need to make decisions for clients based on inherently incomplete information. And how do you get comfortable with that? Some people never do. Some people have analysis paralysis. I've seen this a lot. And they go, on the one hand, and they just can never get there. So you kind of have to be pragmatic while you're on the search, I suppose.
Yeah. Getting to a place where you can like just make a decision is, sometimes you just have to decide. And like, even if it's not the right one, it's going to take you somewhere you're going to learn. Anyway, so I think now to get more specific about all these kind of like general statements that we're making, I do want to, so I was talking about kind of that entry point, and I think the way where I want to start this conversation is just about like, I want to, when we're telling a story, we need to establish the setting. And I think that the setting of this story of your work, of our work, is the technology revolution. Would you agree with that?
Yeah, for sure.
And
let's start there.
And I think the kind of the chaos that is created within that, because everybody wants to be a part of it. Innovation is so hot. Innovation is happening like at every turn. And I know that sifting through that noise, right, is I think a very real problem. To sift through how to sift through that noise. So I hope that in this conversation we can kind of establish that answer, because I do think that's a lot. That's like the approach of your work.
Yeah, well, it's a very special time because people are really excited about technology and innovation, and they have been in recent years. It's not always the case. It kind of waxes and wanes, but we're in currently something like a mania, you could say, and that's been the case for a number of years. And that makes it particularly dangerous, and you have to be very careful because, as we wrote in the white paper, most technology revolutions, quote unquote, are bogus. They're not truly revolutions in the sense that we're speaking about them in the context of what we do. There's technological change. There's winners and losers within technological change. But trying to understand who is going to come out on top, who is not, what is going to happen within a specific technology, a lot of that you just can't know. It's speculation. Speculation meaning you're just kind of guessing. And when you're managing wealth over generations, you can't guess. That's not investing.
So maybe this is kind of the interesting paradox, which is that like here we're pairing innovation, which I think can be understood like very superficially or on the surface as like something that's like a short term kind of, yeah, like something that requires speculation. And yet when we talk about innovation, and we're actually talking about it with in relationship with like resilience and like planning, like generational mindset.
Yeah, people hear innovation and they think risk. They think this is something I'm just going to dabble with a little bit because it's way too risky. That's not something I want too much of. Let me keep away from that. I'll play with it. That's the play money. And I think that's a key disconnect, is the realization that innovation is an extremely broad term and it drives all growth over that generational time frame that our clients care about. So if you're going to be investing, if you're going to be aiming to protect and compound your wealth over that time frame, you need to understand these trends, right? That doesn't mean that you want to go and speculate on a lot of uncertain things, but you need to take that into account in any investment process and have it be the center of your investment process, not an afterthought, not something that you have a little VC portfolio on the side to do, fun little ventures, but something that is intrinsic to the analysis and the underwriting of risk that happens in every asset that you own. So how do you do that? Like, getting to what you said about resilience, those two things, those are the two lodestones of everything that we do. Resilience means resistant to change, durable against change. Innovation is the wind of change. So you want to find companies that have a balance between those two things.
So talk to me about what can happen in a revolution, right? Because there's obviously wealth that's created, but then there's wealth destruction that also happens. And so I think that's what you're kind of speaking to. Like that has to be assessed in a certain way so that you can ride the weight of innovation in a less risky way.
Yeah, and that's why the resilience is such a key part, because innovation as the wave of change creates incredible new wealth, but it also destroys. It destroys broadly, and it destroys more, and like numerically more than it creates, because you have new winners that usually emerge and get bigger. You have a small number of companies that are able, even if they're bigger established companies, that are able to identify the change and embrace it successfully. But that's a minority. So um, like everything, it's a double-edged sword. It's has many facets. Innovation is a good and it's bad depending on your point of view and how you're positioned and how resilient and adaptive you are to these changes. So um, yeah, keeping it very high level, essentially what you need to do is you need to find that balance. You need to find those companies, those investments that are positively exposed to the change, but then resilient enough to live through the inevitable bumps, to resist competition, to have a business that is secure enough and embedded enough in something where they can take those changes and apply them across that business and make it bigger and better rather than, that they're going to be constantly reinventing the whole company. Like, um, again, the word is balance between those two big forces and trying to strike that. And that is a bit of an art. But that's ultimately the goal that you're going for.
Can you give an example of a company that has been able to achieve this?
Yeah, let me give a historical example first, right? So if you were to look at the biggest companies in the world in 1990, it's full of oil companies, Procter and Gamble, IBM, and Walmart would be on that list. And Walmart is an interesting example, not from the most recent, computing revolution that has been taking place in the last few decades, but just go back 50 years, right? Like why did Walmart win? They're just a store. Like they're not doing anything incredibly unique or special. You would look at that business and say they they don't have particularly high barriers to entry. They're just they were just a general goods store for many years. And if you go back to the mid 70s, Walmart was a good business. But what they did that was so special was they identified. So that was when um, digital point of sale units were first coming out, digital cash registers
Mm.
and digital stock keeping, digital inventory management. The first computers were being rolled out to do this sort of thing. Okay. So IBM came out with one of the first, truly high end digital point of sale terminals. And Walmart recognized what the benefits of this would be. And they embraced this technology wholeheartedly. And the benefit that it gave them, what it enabled them to do was to become the Walmart that we all knew, sort of that behemoth of the 1990s that was always associated with, oh, everything's going to become a Walmart. Because what they were able to do with this technology by embracing it making it so intrinsic to their operations is they were able to better manage and identify what is the inventory that we have, what do we need more of,
Mm.
how can we reduce cost, how can we go and extract better terms out of our suppliers. So the whole low price guarantee Walmart culture emerged out of the embracing of this new technology and
Mm.
using that in a way that competitors never really couldn't, embed it into their culture in the same way. And Walmart created a business model around the ability to do this. And that's how they, embraced what was a technology revolution. That was the very early days of computing. But they took an existing business and sort of captured that wind of change in a very positive way to get bigger and stronger and to grow and compound at a high rate over the next 20 years.
Does that mean that you are assessing and in your research, you're looking for companies that are embracing technology in the way that, for example, Walmart was?
Yeah, that's part of it. Um, Sometimes we're doing work specifically on companies that are purveyors of the technology. So they might be selling equipment that's tied to the technology. Whatever it is, you're looking for businesses that are somehow leveraged to, somehow harnessing the growth from this technology. So it could be as an input to what they're doing. It could be as a key enabler to what they're doing. It could be as a supplier to the technology itself. But whatever it is, it needs to be a business that has those aspects of resilience. Resilience meaning resilience to competition, resilience to, structural change, um, all the sorts of things that we look for that breaks companies. So if they are resilient and durable, and in some way they're going to get growth by harnessing this technology, that is the key combination. And it comes in many different forms. It could be a company like Walmart that has sort of an existing business that's kind of embracing the technology and making it a key part of what they do. It could be a company like a semiconductor capital equipment company, that is embedded in a certain process within a fab, and barriers to entry are very high. It's very difficult to displace them, and they're going to grow over time because the demand for that is tied to the growth of semiconductors and computing. Um, there's a lot of different ways to approach this, but those core elements of being tied to the growth, being resilient, those are the common denominator of everything that we do within the strategies.
So there's two things that came to mind. One thing was I was curious about where we are in the technology revolution. And then also, you've said computing revolution. Is that the same thing when we hear those?
Technology revolution is a general term, and it can apply to computing. That's the most obvious one. That's the one that we're living through most obviously right now. And we've seen that just in our lifetime, how things have changed with the exponential growth of compute, semiconductors, and chips being in everything, being in everyone's pocket. 15 years ago, they were not in everyone's pocket. That is a very obvious revolution. But a technology revolution, the idea behind a technology revolution
It's like all of
is,
it, right?
yeah, it can
Yeah.
be anything. So,
Yeah, yeah.
like, go historically, technology revolutions were the internal combustion engine. It was the steam engine. It was electricity. So, and if you were to look today and say, okay, what are the sort of earlier stage, more budding, potential technology revolutions? I think you look at genetic sequencing. I think you look at solar PV modules. I think you look at orbital lift, so putting stuff up into space. You can look at maybe 3D printing sintered metals. All of these things are in various stages, probably in sort of descending order of what I just said of maturity. But like, they operate on the same principles. This notion that as something gets cheaper, demand for it increases, and it exponentially gets cheaper, demand exponentially grows, it gets used more widely for more and more things as it gets cheaper and more available. And that has fundamental changes to the way we live, the way we operate the economy. And those are the technology revolutions.
Okay. And so is this when the idea of something turning into a general purpose technology comes into the conversation?
Yeah, so those two terms are pretty much interchangeable. General purpose technology, technology revolution. Um, yeah, because the technology revolution changes everything. And a general purpose technology is one that changes everything because it is ubiquitous. It becomes used very widely. So think of the internal combustion engine, for example. Great example of something that creates a techno-economic paradigm, as Carlota Perez would say. Because just look at what happened. Like, okay, now we all moved into suburbs. You could travel by car. You had just the whole transport system changed. People's lives changed in so many dramatic ways because you had cars and airplanes with engines that you didn't have before. And that was a very, very, ubiquitous thing that was used widely and thus had that revolutionary effect.
There's like so many ways to skin this cat. I'm like techno-economic paradigm.
It's just a fancy way of saying, life changing in a big way.
Yeah. Yeah. This would be an example of where I don't want to get too into the weeds of that, because I'm about to go down that slide and I would love to. But I think what might be more interesting for now is to maybe pivot a little bit to our research engine, our approach to research, because that's how you achieve what we're talking about. And I guess it's unique and it looks different. So I would love for you to talk me through your Bespoke's process.
Yeah, well, a process is always a work in process, or work in progress, I should say. So, the core principles never change, but the way you implement them does over time. But what are those core principles of what we do that's different? Because I've worked at a bunch of investment firms. I've seen many, many investment firms, in my career. And they're all a little bit different, but most of them are kind of the same in many ways. And I think one of the nice things that attracted me the most about what we can do at Bespoke is that we're not bound by many of the same institutional constraints that others are. First and foremost, we can take a long-term time horizon and really mean that. Um, I was talking with a hedge fund manager the other day, and he said, "Oh yeah, we have a pretty long-term time horizon, about 9 months. That's what we focus on." And I was thinking, that's not very long. um, in our case, we are managing wealth specifically for clients who are thinking in generations, because they're aiming to protect and compound this this wealth that they've created already over the course of their lifetime, thinking about generational handover, thinking about the big picture, essentially. And when you think and talk about all this stuff, technology revolutions, blah, 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 ultimately that's the result of an exercise, which is, well, what matters over that time horizon? Like, what really matters 10 years from now? All of this stuff that is on the Bloomberg screen in front of me right now, we're going to forget 99% of it. So how do you build a process around researching the stuff that actually matters over that horizon? And that's
Matters
where it
to who?
starts.
Matters to the client, or matters to who?
Oh, matters for the value. Like, what is the value of that investment you're making today, 10 years from now?
Mm.
The business you're investing in today, what is going to matter to the value of that business
Uh,
in 2035,
uh,
when we've forgotten, most of this, and
yeah, when the
and
world around
only
us looks completely different and in a way that we can't even imagine right now.
yeah, partly in a way that we can't imagine, but partly in ways that we can, which is getting to this notion of why general purpose technologies, why technology revolutions, why do you build a process around that? Because they're fairly predictable relative to other things where you're mostly just speculating. And we'll put a pin in that because you asked about process. But
Yeah.
the point
Great.
is,
Thank you.
tying this to the process is focused on researching and deeply understanding those big forces. What is driving them? Who is exposed to them, and in what ways? So if you were to go to any other investment firm, including most of the ones I've been involved with, what are they actually doing all day? What are they reading? What are they thinking about? It's not this stuff. They're thinking about, okay, next quarter, the estimates are too high, and, should we get out of the way a little bit because they're going to miss? And what if management comes out and says this thing? And none of it matters. none of it really matters along this time horizon that we're talking about. And yet it's like an engine just consuming so much mental fuel by so many super intelligent people. That's how the business is set up. So our process gives us the luxury to be able to say, okay, like forget about that. Like we don't need to allocate resources to understand every little dip and wiggle along the way. In fact, we're going to try to step away from that. And if a business that we think is a great business along the lines that we just described before, nice combination of those characteristics, et cetera, et cetera. If a business like that is down in the dumps because, hey, they had a bad quarter, or the macro cycle is against them, or they had some inventory problems, or inflation didn't go their way, that's an opportunity for us to kind of put our long-term
Thinking.
glasses on and step in and buy from the people like that who don't want to own that. And we always have businesses in client portfolios that other investors, other Wall Street analysts are just like, oh, there's no reason to own that now because,
Mm.
things aren't going to start getting better for at least another 6 months. And, the news flow is going to be negative. Like that's the kind of thinking. It's sort of short-term speculative thinking that drives flows. And that's taking the other side of that very deliberately is kind of the core philosophy around the research that we do and the things that we spend our time reading about, focusing on, building models around, trying to gauge where things could go. And that is itself a huge advantage.
Yeah, how did you get out? I mean, if you've been working in those environments, I mean, you know what that looks like, but like there was a moment where you like made a decision to do something differently, and then you like followed a journey to find this group and like work with people where like your energy actually isn't harvested and like people are thinking in a longer time horizon. I find that pretty interesting because I think that like that mode of being is so um addictive, common, like everything is really built around this short-term framework that is harvesting our energy.
Yeah. I mean, that's a conversation in itself, but the short answer to the question or to what you just said is most firms are constructed that way because that's how the industry works. That's how that's how funds, selling products, they get paid on short-term performance. Short-term performance attracts hot money flows to come in. Oh, these guys are super smart. Look at what returns they've put up. And then inevitably things revert to the mean and the money flows out to the next thing. And everyone is sort of jostling to put up those numbers in order to get attention, to attract new clients. It's very transactional. It's very short-term oriented. Um, it's not standing next to the client and saying, okay, we're going to put together a 10-year plan for you and stand by you while you do this. That's investing. I don't really know what the investment industry is, but it's not quite investing. It's something a little different.
Wow.
Um, but that's what makes what we do so much fun because like it's exhausting. The other stuff like it's
Yeah.
it. I mean, I won't go on and on, but you get the point.
Yeah. I mean, I want to go on and on about that in another episode, which we can do. But so back to the research.
Back to the research.
Back to the research. I don't know. Was there you were talking to me about your process and like the depth that you can go into because we are working with a longer time horizon. And so I cut you off.
Yeah, so I guess just to hit on some of the key aspects of what we've built in deliberately to do things differently in the way that we think they should be done. I mentioned the time horizon aspect, which is a very big one. Um, the other aspect of it is just building um, deep expertise on some of these longer term forces. So we didn't talk about geopolitics, but geopolitics and understanding that and having a view on policy, on trade, on supply chains long term. What is the balance of forces? That's a big part of what we do. And that's also a very long-term discipline focused on kind of these fundamental things that change pretty slowly. So, that is in many ways in the background of all of this, because it's not just, which businesses you want to own, but we're a global firm. We take a completely global approach. We can go anywhere, and our portfolios reflect, we have a minority of exposure in the U.S. because the U.S. is actually a minority of the global value, believe it or not. So which countries have tailwinds? Which ones have risks that you don't necessarily want to be exposed to? How do you anticipate the fracturing of supply chains globally, between Chinese-oriented supply chains and US-oriented supply chains, for example, and build that into your analysis? That's sort of the geopolitical stuff. And then purely on a technology side, one of the great benefits that we have in being able to take the time to focus on these things and focus on individual companies, because we're really sort of taking an approach that it's as if you were buying the whole company. And that's a key thing that is part of our process. Is if you wouldn't buy the whole company, then you don't buy any of it. It's not a trade. It's not a little piece of paper that you're playing with. It's an ownership stake in a business, and that is really essential. So if you're building an ownership stake in a business and you're really thinking long term, then you can be picky, and you can take your time to really, identify the ones that are special, and also take the time to research them. So that gets to sort of the network and the club that we've built for our own internal use over time, which is just a pretty large group of people in industry that we've created this dynamic around, where they're sharing information with each other. They're teaching each other about their industries, and they're teaching us. We have the ability to tap into that. So if we're doing some work on something involving med tech or surgery, I can call up, the person in the group who is a surgeon, who is exposed to whatever that technology is, whatever that business is, and get the really on the ground view of those longer term things. What is adoption here? How well is this company run? How differentiated is what they're doing? All those sorts of questions. And that's so rare, because most people don't have the time to do that, because they constantly are on the hamster wheel
Yeah, there isn't an
of
incentive
quarter to
to do
quarter.
that.
Yeah, I mean, there's an incentive, but there's limited resources and limited time. If you're churning through names more quickly, you have lots, hundreds of names in the portfolio with some of these mutual funds. Like, there's just no incentive or no time. And in any event, very few are doing it.
Okay, thank you. Okay. I feel like you've pulled on all the strings I wanted to pull on. There is this idea that, and also just for the listener, a lot of this conversation is being pulled from a white paper that Rob wrote called Technology Revolutions in Investing, which you can get access to if you ask nicely. Just kidding. But something that you wrote and we've talked about before, is just like that it's not necessarily about an advantage, an information advantage per se, but an analytical and behavioral one. And I think that we've gotten into that. I think that the way that you approach and we approach research is already showing that, like this shifting from a short-term view to a long-term view, being able to curate and focus on like really specific sectors and industries. I guess what I would ask you, maybe what we could get into is like the balance of private and public markets might be interesting to explore a bit, because I know that we're really interested and we focus on public.
Yeah. I mean, that's that's a big topic. So I'll try to keep it high level, and then we can jump in if there's any place you particularly want to go.
Yeah, or just I mean
But
how it fits into the innovation conversation.
yeah, so the way that we generally approach public-private. So first of all, everyone is over allocated to private, way over allocated to private. And one of the key kind of tenets of the firm, and one of our main theses, you could say, is that liquidity is just systematically undervalued. So long story short, we're in a what I like to call a volatility spiral, where that's just a fancy way of saying things are getting crazier and crazier and crazier because the craziness feeds on the crazy. And that means just volatility within policy, volatility within I mean, conflicts breaking out. I mean, we see this ship go sideways in the Suez Canal. I mean, all sorts of
Chaos.
unexpected, yeah, chaos. I mean, that is volatility. And the key aspect of volatility is you need to be able to move. You need to be flexible. You need to adapt. You need to
Wow.
be resilient. And the problem is that you need liquidity to do that. Liquidity is like the oil that lubricates your movement, to identify and adapt
Oh my
and
God.
seize the opportunities. And everyone they're like the Tin Man. They've got no oil. They're stuck in
Oh my God.
uh, private structures, and they cannot get out for years and years. And this is starting to dawn on people that this is a huge problem. So that's kind of the backdrop. And one of our core tenets, as I said, is that liquidity is good. You want to have a lot of liquidity. And when we talk about the innovation strategies, the equity strategies that we manage for clients, the vast majority of that is going through liquid, publicly traded equities, which systematically are underappreciated because they give you liquidity.
Why has this hamster wheel been created around the private markets if it clearly like people are waking up? You just said it's dawning on us. That's wonderful, right? But I mean, now there's a whole set of challenges that need to be solved. I'm like, now I have a million questions. Does that mean that somebody who's in this position and then it's dawning on them that they need some liquidity can talk to you, that you can help them? I mean, what is supposed to, if you're the Tin Man and there's no you don't how are they getting access to oil to loosen this? And then of course, my curiosity is just like, okay, well, why has this structure been built in the first place? But maybe that's not where we should take the conversation. Maybe the conversation is more about somebody who's feeling like the Tin Man. How do they get out of being the Tin Man?
It's worth briefly talking about why, because it's relevant to clients and people who might be listening to this. Um, Again, not to paint such a bad picture of the investment industry all the time, but it's institutional incentives that made this happen. The institutional incentives are, number one, if something is private, it doesn't need to be mark to market. And everyone likes that because clients don't have to see it and worry. The investment manager gets to show a line that constantly
Oh.
goes up and to the right in terms of value.
Oh, more control
Uh,
over the story. There's more control over the presentation.
yeah, more control over the presentation. There's a lack of feedback and information, which serves everyone's interests. The client, because they don't need to show that their portfolio is volatile, even though in reality it is. But you do these marks to model. Essentially, you try to value, but there's no public market for it. You wouldn't see it going up and down like this, which is stressful. And the investment manager doesn't like that, because then they can say, oh, well, look, every quarter is just appreciating. Oh my goodness, it's so steady. It's incredible. Um, so you get that.
Yeah.
There's also an element of like exclusivity, like, oh, public stocks, any Joe Schmo can buy that. Well,
Mm,
I have deal flow. That's the term. I have deal flow. I can
deal
go,
flow.
I'm getting deals brought my way, and I can get you into these deals if you come with me because I'm well connected. Like, there's a whole kind of exclusivity
Oh.
element to this that's very strong, especially on sort of the personal, um, individuals and families and that sort of thing. Like that's very, very prominent within that side. And then
Mm.
on the institutional side, so endowments, foundations, everyone is following the Yale model because in the late 1990s, this is like a whole rabbit hole. I'll just tease you with this, and
Okay.
this is like way too nerdy
Yeah.
for our purposes here. But in the late 1990s, long story short, a guy named Swenson, who was the head of the Yale endowment, wrote a very influential book because Yale at the time, most endowments and foundations and pensions were like stocks and bonds, call it a day. And he basically made this argument and said, hey, we're an endowment, we're Yale, we have this 100-year time horizon. We can make more money if we invest in private equity and private debt and private commodities and farmland and, hedge funds and things that lock you up because we're getting paid extra for taking the liquidity risk, for giving away the oil, right? And Yale did very well for an extended period of time. And the problem is, like everything in investing, every trend sows the seeds of its own demise. Well, we're here 25 years later, and now everyone and their uncle has followed that strategy. And not only are you not getting paid or compensated for taking the liquidity risk on most measures that people have made over the last 10 years, you're paying extra to not have the liquidity, to not have the ability to move, which is just, it doesn't make sense, and it's sort of madness. But that's the power of that trend. And of course, you know, uh, a lot of institutions emerge to capitalize on this. There's a lot of incentives to keep that going. And now you're starting to see that really get called into question, and big endowments saying, oh my God, we need flexibility here. And to answer your second question, yes, that is a big thing. Like very commonly, we're helping clients who have gotten stuck in Tin Man territory and stuck into private investments that are either illiquid or they're slowly kind of bleeding out, kind of venture related things. And a big part of what we do is helping them restructure, helping them transition into liquid strategies that can achieve the outcomes that they need without while retaining flexibility. And that's obviously a process once you've gotten locked in to some extent. And there's circumstances where you can get unlocked, but that's a whole, complicated story. But yeah, that is a major need for clients. And that's something that we kind of have started to, you could say, specialize in to some extent. Um,
Yeah.
but yeah, the liquidity is our credo, and I don't anticipate that changing. Maybe for the rest of my career. Like that is a Titanic that has taken a long time to turn, and now that it's turning, it's not gonna veer back in the other direction for quite a while.
Things are changing. I feel, yeah, across the board. Okay. Is there anything that you feel like pertaining to this topic that I didn't ask you about?
Yeah, essentially this notion of how do you harness innovation while not taking unnecessary risk, and just like why are general purpose technologies more predictable? Why are certain businesses, how can you get comfortable underwriting the risk of 10 years out? Like that's a wicked challenge. And this is the answer to that challenge, is by focusing on these processes that take place along fairly predictable paths. And I'm not just like, there's plenty of academic research on this. I mean, it's essentially Wright's law, which says, that these are predictable paths. So if you can extrapolate what's happening in front of you, like, I guess, putting it in a less abstract and nerdy way, one of the biggest lessons I always learned from my mentors in the business was investing is not about speculating about what's going to happen in the future. It's not about saying, well, I think like this probably will happen. It's about looking at what is happening now and anchoring yourself in what is happening now and what does that imply for that trajectory of what is happening now. That is investing. And when you talk about these general purpose technologies, that is why it's not speculation, because you can look and you can see solar panel prices are dropping at this rate over this period, and it's already happening. And if you extrapolate that forward, what does that mean? What does that imply with some band of uncertainty, right? Because you don't know exactly how fast or what the circumstances are going to be. But I can tell you with a high degree of certainty, I'm pretty damn sure that 10 years from now, there's going to be a lot more solar panels in all over the world,
Wow.
exponentially more than there are
Wow.
today.
Hmm.
You know, you can quote me on that. And
Okay.
that's not speculation, because it's taking that, what is in front of us today, and saying, okay, this is a force that we kind of know how to measure and gauge and predict. And that is the underlying basis of how we can underwrite those investments over that kind of time horizon. That's how we can leapfrog the people who are on the hamster wheel and say, okay, we have confidence, within bounds that we're controlling for, that the world is going to look something like this in this particular way.
That's pretty powerful for the moment that we're living in, when I think people are, yeah, the chaos and the what feels like uncertainty and lack of control. You're expressing a reality that I think would sound very attractive to many.
But it's chaos, but the flip side of the chaos is chaos often happens when you have big technology change. And a whole nother conversation, but you could point to a lot of the chaos happening more broadly and look at the internet, how that's changed communications, how that's changed media. Like, that has had a huge impact. And the same thing happened 100 years ago, when you had talk about internal combustion engines and communication technology and electricity. Well, that brought you modernism and the First World War. And I mean, all of these hugely traumatic experiences, but that also created the flowering of modern life and all of the wonderful aspects of it. And I
Wow.
mean, these things go together. And and just to tie it into the impact thing, like, look at how many people, like, take it back 100 years, how many people were living without any freedom, without any choices, living with terrible economic conditions in 1900, that then 30, 50 years later, their lives were transformed by having electricity and cars and all of those aspects. Um, that is the power of technology to bring impact, because general purpose technologies are by definition democratic. They give power to people who are powerless because they make things cheap. They make it available for you to get access to things that you couldn't before. So just to take one example from today, solar panels are a great example of this. So solar panels make it dirt cheap to get access to electricity. And to take one specific case study, look at what's happening in Pakistan right now. So Pakistan is a dysfunctional state. The institutions are very rickety, and specifically in some of the larger cities, the electric grid is really just completely falling apart. And what you're seeing is that previously, instead of being beholden to that and having to deal with blackouts, brownouts, having to, have your lives be seriously negatively impacted by this, Pakistan is one of the largest growth markets for solar panels, because everyone's saying, screw that, I'm getting off the grid and I have the power to install solar panels on the roof of my business, on the roof of my home, and I can, you know, power the refrigerator. My kids can have light to do their homework. Like, all of these things that previously you didn't have, you were beholden to someone else. You didn't have the agency. Solar panels makes that possible. And that's just kind of a goofy little specific example, but that's why general purpose technologies although they tend to be born and bring with them this kind of chaos and volatility and craziness, they also are the harbingers of much, much better things to come. And that's where the wealth comes from.
You just shone a light on on this example, right, of technology that is like just objectively not a scary example. I don't know. I can't help but start to think. I can't help but think. I'm thinking about your comments too, and how we talked about before, and in the white paper of just like how anybody can really spin something to being a revolution, and then typically around, the way that that's made possible too is like this marketing. I mean, I don't know. Also, as like where I'm wearing a marketing hat, and like the way that people can use marketing to kind of create a story, evoke an emotion, like all right. That feeds that chaos. And I just wanted to ask you, like, if there were any specific. Could you give me an example of like one of these dangerous examples where it's like BS, a false tech rev?
I mean, yeah, there's a lot. I mean, in the investment world, pretty much every company has some kind of story about how they're doing something extraordinary and innovative and new, and it's not. Let me give a very specific example from today. So quantum computing. That is an area that has a lot of hype, a lot of attention. A lot of people have gone into it. That is not a general purpose technology, right? That is dependent on making significant leaps in capability that we have not gotten close to yet, despite all the press releases and headlines and things like that. So it's not getting dramatically cheaper. It's not being produced in greater and greater quantities. That is a speculation. Like, yeah, maybe someone will come up with some crazy new way to do this that will cause a huge breakthrough. But you have no way of anticipating that. You just have no idea. And it's the same thing, like, take something like titanium, right? Let's, in a different approach. Titanium, we talk about steel in the piece. So let's take another metal, right, and compare
Okay.
it.
Yeah.
And steel itself got much cheaper over the course of the 20th century, like even way after the best, like all the 19th century stuff that we talk about in the paper. Steel got way cheaper because of the emergence of EAF mills and all of, lots of innovation happening. So that was a very long process. Compare that to titanium. Titanium has not gotten any cheaper on an inflation adjusted basis for like 75 years. And the reason is because they make it today in the same way that they made it 75 years ago, in the mid 20th century. There's been no breakthrough. There's been no, innovation around the process of making titanium that has unleashed the general purpose kind of force where exponential growth of production drops costs exponentially, which means exponentially more ubiquitous use. That has not happened. So titanium is a weird little niche thing. You probably didn't think about titanium once in the last 6 months until I mentioned it just now, right?
Yeah, correct.
Yeah. Like, yeah, there's some things that use titanium, but it's expensive and it's niche, just like
Yeah.
steel was for 3,000 years before someone unlocked that process through the Bessemer process. So when people talk about innovation, most of the innovation and kind of stories are around things that are speculating on, oh, well, that would be really cool if they figured out a new way to do titanium or quantum computing or, insert whatever it is that has not shown those dynamics. But again, you have no way to know. And most of the time, that's just not happening for most things.
No, I mean, it's like one thing to have an idea, or a fantasy, and then, but what is the, yeah.
Well, in investing, especially because the people on the other side have a big incentive to sell you the fantasy because they're literally selling you stock. They're raising money from you. So these aren't scientists who are just saying, oh, we're really optimistic. Like, these are people who are, in some effects, salespeople. So you have to take that with a big grain of salt when you hear big claims about anything. And that's why, if you were to look historically, most things are kind of uh, hyped up speculation.
Look, we're talking about investing, but I think that this conversation like isn't just for investors. And so I think that we pulled on some context that is super relatable to people that are like the classic investor.
It's not really for investors, because most people who self-describe as investors, they want more action. Like, what we're doing is for people who have created great wealth, and they need us to take care of it for them. They don't want to lose it. They want to protect it. They want to compound it. They don't want to be sitting there, hey, what are you guys doing today? What are you trading? Because that's not how that's how
Yeah,
most like traders and investors operate.
right.
And that's the antithesis of what we're doing. So in many ways, this conversation is deep on the investing, but it's not really for investors.
Yeah, different game. Okay. So yeah, I just wonder, AI is top of mind for everything. I think, if we're going to also just talk about stories and marketing and all of the hype and chaos that's around that term, like, can you just like offer some sort of grounded point of view or perspective or thing to say within this conversation of technology and innovation investing?
Yeah, it's an important topic, and we should talk about it because it's a good example of something that's playing out today. And how do you think about it? How do you approach it from the standpoint of our clients with that time horizon, in the context of what we do? So AI is legit. It is a legit revolution. That is, full stop, the truth. How do you harness it? Well, there's not many good ways to do that right now. Because when you talk about AI, you're talking about two things. You're talking about semiconductors, essentially, and all of the infrastructure that makes AI possible. Because AI, as we said, is the apotheosis of computing. Computing is turning sand into mind. That was always the phrase that people like to use. AI is just is computing to an exponentially higher level of capability. So it's a continuation of that revolution that has been going on since the late 1950s, really, in its very earliest stages. So that's important. This is not coming out of nowhere. This is legit, which is why all the great advances in AI have happened, because computing got cheaper and cheaper. Like, people knew about backwardation. People knew about these machine learning techniques back in the 1980s, the ones that unleashed the AI that we have today. They just didn't have powerful enough computers to do them.
Mm.
So like, it all remained on the blackboard. And in the mid 1980s, like, this was a big thing. And they're like, well, in theory, that's great. But in order to really do this, we just can't. And then somewhere in the mid 2010s, you could. And so it unleashed, that next level of compute, which is AI. So that I think is an important thing to bring up. So where are we in that? So you're seeing two things: all of the AI speculation, all of the excitement, and all of the growth and the valuation, blah, 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 is around the infrastructure to provide AI. So you're talking about the semiconductor firms, you're talking about the hyperscalers that are delivering it. Think of it like the electric utilities in the 1920s, right? That was a time when electricity demand was really starting to take off, and you had these huge, like, companies that were large really start to turn into these enormous conglomerates
Like Con
that
Edison.
were, yeah, like
Is
Con
that what we're
Edison.
talking about?
Yeah, Con Edison is a great example. And at the time, these were hugely profitable conglomerates. So Edison, I don't know if we talked about this. I'm glad you brought that up. Con Edison had higher profit margins in the 1920s than Google does today. Let
What?
that sink in for a minute. That is
Oh
true. I've
my,
gone back and looked at the financials.
oh
Um,
my God.
they were an extraordinarily profitable business, dispensing electricity, building the infrastructure around what was to be, one of the key technological revolutions of the 20th century. That was an enormously profitable business at that time.
Wow.
And then those margins never got anywhere near that ever again, because they built out the infrastructure to enable this, but the marginal return on capital, the incremental margin, you could say, was very bad, because they're building a ton of physical stuff. And when you're building a ton of physical stuff for something where the price is dropping exponentially, that's usually not great, for most people, most companies in that supply chain. So that's, similar to where we are today, where you have, NVIDIA has, 40 something percent margins. I mean, different business, obviously. NVIDIA does not have tons of physical assets, but the point is there's a lot of profit sitting in that infrastructure stack, and the hyperscalers are making a lot of profit. Microsoft Azure is making a lot of profit.
I see.
So
Okay.
that's where kind of a lot of the excitement is around right now. The thing that's really exciting about AI, and yes, like there's a lot of good investments in semiconductors and the related equipment, and we own, names like that for clients because they're tied to the growth of semiconductors. And if you can pick the companies that have those durable margins, that are selling
Mm,
an essential piece of equipment, like that's a really good place to be. That meets the criteria of what we described earlier. But the place that's really going to be most interesting for AI is, yes, some aspects of the infrastructure stack. And that's, as we sit here today, there's not a lot of good investments to make there because everything is so expensive, because everyone is just way to the moon in terms of their expectations. And this might date the conversation a little bit because things might change pretty drastically in the next year or two. But as we sit here today, like, that's the situation. The really interesting thing with AI, though, like if you were to think of, oh, electricity, what an incredible revolution. The things that it enabled were much more interesting than owning Con
right.
Edison.
Yeah, yeah. Right.
Yeah. So when you think about like the Walmart example again, here's a normal quote unquote business that said, oh my God, we can really use these new point of sale computers to transform our business. Who is going to be the Walmart of AI? Like some companies are going to do that extremely well and absolutely explode in terms of value creation and innovation and what they're doing and growth. And the companies that don't are going to be absolutely screwed. Just like Walmart's competitors, can you even name them anymore? They've all died with a few exceptions, but there used to be dozens of them.
Hmm,
And the ones that didn't adapt went away.
hmm.
And that's sort of where we are with the AI situation now, where you're just in the nascent, it's like the 1976 for the Walmart example. Like some companies are sort of figuring this out. It's very early. Most of them are still, "Nah, nah, how do we use this new thing? I don't know."
Yeah.
And they're locked into existing business models that often make it hard to change. There's a lot of stasis. There's a lot of stuck ideas and stuck capital. You go to Clayton Christensen, The Innovator's Dilemma. He wrote about this extensively, how businesses that have an existing model, it's just so hard to change. And that's where we are now as we sit today, is like, okay, we have exposure to picking our spots over here, but that's, you have to be cautious. The real big opportunity is going to be in that latter group, but it's still too early to identify with any, like, remember, it's not about speculating. It's about looking what's in front of your face today. We want to be able to see those companies that right in front of your face are using AI in a very transformative and native way. And you can say, aha, that is, who's going to be, strengthening because of this, not weakening. And then you can invest with more confidence.
Okay. I would love for you to give the visual of the that you provided yesterday, which is that of wind blowing over a castle and this idea of resilience. And because I think a huge part of building and creating a castle that can withstand that storm or that wind, is this negative approach that you also talked about. So I think that those are one and the same. I actually think that this is a great way to kind of wrap up this conversation, and leave it at that.
So the foundational idea behind the negative approach, which I coined a new term called reverse Tolstoy frameworks, which is really pretentious and shows the English major
Super
coming out.
relatable, Rob. Really relatable.
But it's a clever way of saying, because everyone knows the quote from the beginning of Anna Karenina, where Tolstoy says, all happy families are alike. All unhappy families are unique in their own ways. And the reverse Tolstoy frameworks is a funny idea that basically says, well, businesses, it's the opposite. All of the happy stories, all of the businesses that are able to earn extraordinary returns, are able to grow far in excess of anyone else, the Apples, whatever extraordinary example you want to look at, they're weirdos. They're outliers. They're all idiosyncratic. And there's some kooky story that emerges to create them in many ways that can be often hard to anticipate. And everyone focuses on, oh, what are the ingredients of the super companies? And, oh, it's management. Remember there was a book that was very popular, I don't know, like 15 years ago, called Good to Great. And everyone loved this book. It was about these companies and, oh, they are truly great. And here's how I know they're so great. And like in the end, half of them ran into trouble and the book was a total bust. But the point is, it's really hard to identify the great because it's inherently unique, inherently idiosyncratic. It's much easier to weed out the weak and leave the ones that could be great, but probably will be very good. And that's the reverse Tolstoy's framework, is that the sad stories, the companies that earn mediocre returns, that cannot maintain their growth because competition comes in to take it away, that get disrupted by structural change or new technologies, those are the common stories. That's the everyday. And you can apply certain frameworks to identify the patterns of that happening over and over again, because that's gravity at work. Capital chases returns. It's very difficult to earn extraordinary returns, to earn extraordinary growth over a long period of time, because the system is trying to take that away from you. That's gravity at work. So my training primarily was on the short side, identifying these businesses, these patterns that occur over and over again. Why is a company vulnerable to competition and other companies are not? Why is a company vulnerable to this technological shift and what's being done? How are they being disintermediated? How do those things happen again and again and again? And that's getting back to the question of process. That's where the process starts. So you don't start this process by trying to find the extraordinary Walmart in 1976. That's later. You start the process by weeding out the non-resilient ones by applying these frameworks that are fairly predictable, fairly repeatable. And you can, we're starting to use AI to help us begin this process, because that is a process that is doable by AI, whereas identifying the weird, extraordinary ones takes much more creative thinking. So this is the idea of the negative approach, and that's where the process begins. And if you use that metaphor of, the resilience of your business as how strong is your castle? How strong are the walls of your fort? Well, you go around with a hammer and you try to bang on everyone's walls, and if they fall down, then that's not the business for you. And that's the approach that we begin with. And in the end, you're left with companies that, hey, they've actually held up. Maybe there's something interesting here. And that is the metaphor of resilience that I would leave with you, is like the castle walls. And then you have the winds of innovation, the winds blowing, and they're blowing across the whole plain, across everyone's castles. And some of the castles crumble as a result of that. And some of them like put up a sail and catch that innovation, and they just harness that energy and get bigger and stronger and more powerful compared to competitors, and they grow faster. And those are the businesses ultimately that you want to own if you have generational wealth, and you want to own them and you want to hold them, and focus on those two elements above all else.
Beautiful picture painted in my head. And I'm thinking about how businesses and, corporations are like the modern day castle. We're still in medieval times. Just looks
Well,
different.
I guess being in France, surrounded by all these medieval ruins, helps drive the point home.
Yes. Okay, Rob, I think that wraps the episode beautifully.